Rajeev Malik of Macquarie Capital Securities joins in to talk about that. Rajeev, morning. Do you think this improvement that we've seen in small pockets of the economy is durable and we can extend this optimism to the rest of the calendar year?
I certainly would think so. Specifically with India, don't forget the December quarter was an exceptionally weak quarter where the big issue was, apart from the external hit, availability of capital or financing had a huge knock-on negative impact as far as spending itself was concerned. Consequently, we've seen, both RBI being fairly aggressive in cutting rates and a sizable fiscal boost that's come into place, especially the pay commission. And I think we're beginning to see the positive spin-offs from that. Don't forget, this is over $1 trillion economy, and these are just a few pockets that are beginning to show some positive response. But that is still better than, everything being unilaterally and uniformly negative, as was the case through December. And I think RBI is not done with its easing policy. We're going to see more of that. Domestically, don't forget, India remains a supply-constrained economy, so as financing improves, the underlying demand aspects are going to come back. So I do think, we will see better recovery prospects shaping up, and that to a large extent has been our view, that domestically driven economies such as India that don't really rely all that much on exports will be actually first off the mark in terms of improving economics.
Rajeev, morning. The one thing equity markets have been worried about, though, is how stubbornly high the yields have been. 7% doesn't seem to have been a problem. If it does stay there, what kind of impact do you expect to see on real rates, despite what the RBI may be doing and may continue to?
I think part of the huge confusion in India is really about how do you go about calculating real interest rates. At one level you have WPI, which is bordering on, being close to zero, will turn negative. At the other end you have, the CPI, industrial workers, which is still chugging along at 10%. The fact of the matter remains, if you look at a lot of other indicators, whether it's overnight rates, whether it's commercial paper, all these factors have improved, and my own sense is that banks will actually cut lending rates further. It's interesting, one of the ongoing debates in India really is about the whole crowding out, for example, and I just don't see that being an issue, at least over the next year, simply because banks are actually sitting far in excess of what the SLR mandate is as far as government securities are concerned, and it's not that the government is telling them to do that. In fact, on the contrary. So I think rates will actually come off further. That'll be even more stimulus as far as the overall economy is concerned. And I think the whole issue about deflation risk in India tends to be overplayed. There are some sectors, property for example, which are clearly deflating, but the economy as a whole probably goes through fairly significant disinflationary bias rather than being mired in deflation overall.
Where do you stand on the fiscal deficit debate, Rajeev? Because views on both sides are very strong. One seems to be that don't worry about that in this kind of a growth situation. The other is that it's getting increasingly unsustainable and therefore may actually lead to India underperforming from a market perspective compared to other markets which have healthier balance sheets.
It's interesting. If you look at historically, the twin deficits in India, both on the current account and fiscal deficit, have always been there. I think the issue that has come up really is the size of the boost and the hit from sharper than expected economic slowdown, what it's doing to the fiscal deficit. I'm all for, providing stimulus to the economy. I think it is important for the government to acknowledge that, look, it's not as if there's, a blank checkbook waiting out there. I do think it's the right thing for the RBI to actually go ahead and monetize a fairly large part of that fiscal deficit. But at the same time have the understanding that it would have to be quick on its feet as and when things begin to pick up. Don't forget, the whole debate about crowding out in India, again, tends to be misled, misinterpreted in a variety of ways. The whole idea of stepping up fiscal side is to offset the slowdown on the private side. You're not in a situation where both private sector demand is actually increasing, and despite that, the government is actually stepping up its spending program. I think the key to watch is going to be the full budget that will be presented by the new government, and I think they should be forewarned that that budget has to have fairly credible plan as far as fiscal consolidation is concerned. even though I think, S&P jumped the gun and should have perhaps waited until the full budget is presented, there's a fairly serious risk that if governments do not be more mindful of that, ratings could get downgraded altogether.
But what do you expect realistically, Rajeev, to come out in that first budget in a couple of months' time? Do you think they will worry more about fiscal consolidation, or having just taken over, they'll probably be more concerned about stimulating growth and that with steps which may further increase the fiscal deficit in the near term?
Again, I think part of that is going to be a function of the kind of government or the coalition that comes into play. Don't forget, one of the interesting things that oftentimes gets overlooked is across the political DNA structure of different parties, there has been a fairly consensus view on the fiscal side. Don't forget, this is a country that did manage to pass the FRBM Act, no matter it lies in tatters today. This is a country that actually agreed to ending, typical monetization of the fiscal deficit that used to be the standard mantra for the government. I think it's one thing to say that the full budget will be, still provide a stimulus. It's quite another to say that that stimulus will actually be increased. I don't think that would necessarily be the case. And don't also forget that as there are some more convincing signs of economic activity coming back to life, there might even be a less aggressive case for necessarily going that way. So even if they were to come out and announce a fiscal deficit that is as large as the one that would come in at 2008-09, but at the same time give indications about fiscal consolidation, some plan for disinvestment, etc. I think that is what people are looking for. I don't think anybody disagrees with why a wider fiscal deficit needs to be run now. But the key worry is that, look, will it be reined in, or are we just on a completely different trajectory?
The other thing about the markets these past few days, Rajeev, is that the market, or the equity market, I should say, is looking strong, but the data is not, especially from the US. What are you seeing and hearing amongst your colleagues about risk aversion right now? Are people just looking at equity markets more carefully, pumping in more cash, regardless of where the data points may be pointing to?
Well, it's not as if, all the action that you're seeing doesn't necessarily have any help from the data front. Don't forget, you essentially had markets being pretty much in a panic suicidal mode, and the very fact that the second derivative of change is looking less worse is in itself a net positive. You're right that none of the data point is indicating that, look, we're off to the races or things are improving dramatically, but the very fact that A, they're not worsening, and B, they're actually worsening at a less rapid pace, which is the first step you would have before things begin to turn around, is in itself something positive. And across the region, you look at quite a bit in terms of the inventory plays that are happening, especially in electronics. Don't forget, while demand fell off a cliff through December, we've also seen fairly aggressive supply response. So I think second calendar quarter in several countries is likely to see a fairly inventory build-up pop that will help growth subsequently as well.
I heard you talk about the combination post the elections and how they might approach the budget. How much nervousness would you attach to the elections as a factor for us?
I think it's, really in terms of a scenario where things can go bad, that, you just land up having a bunch of parties coming together. A, they're not necessarily sustainable, and B, just have an economic philosophy that goes counter to whatever markets might be wanting to see. And I think to a large extent that lands up being more of a near-term knee-jerk reaction. Don't forget, in the 1990s, there were 4 different governments in India. And that didn't necessarily change the broader economic story as far as India itself was concerned. I think the challenges this time around are greater and spread, more broadly based. And hence there is a need for a bit more concerted action. But I would again say, I think India's history shows repeatedly that, when times are good, governments don't necessarily do the right thing. But when the back is up against the wall, as it is now, at least some things are done in a more right than wrong manner. And I would still think on the fiscal side, there would be a fairly concerted effort to ensure that, it just doesn't continue to deteriorate.